This is our year-end report, and we had a great class yesterday where we did it in person. But before we get started here, let's just take a second to look at these disclosures, disclaimers, not a personal situation review. Always talk to a legal advisor or a tax advisor. Cetera is not doing any of those things. Some more disclosure information here. Can't directly invest in an index. We all know that. And of course, as I said yesterday, was a gangbuster day. We it was a little bit cold, so we missed a few people who didn't want to brave the cold. But it was sunny, so everyone made it out. And here's a picture of those guys waving hello to you. We wished you were there, and but we're glad we're able to talk to you today. Let's go ahead and talk about the investment market, update and see what's going on with that. Obviously, the stock market, especially this year, since we had the um, tariff tantrum, is like what I like to call it. I mean, since there, year to date, we're up about 16%. And that's not really surprising considering the earnings have been through the roof as well. It's just amazing to me that these companies continue to produce earnings at the rate that they are. And that's, of course, been driving the share price. In addition to that, the AI has been making these companies more efficient, and they've been laying off people in droves, which really drives down the cost of their health care. So companies have more earnings, and earnings directly translate into stock prices. But it's just been going up and up and up, and we haven't really seen this many, I guess, new time highs in a while. But you can see that these are from year to year all the new all-time highs. And in 1995, we had 77 new all-time highs. In 2021, we had 70. This year so far, we've had 36 all-time highs, and that's just how it goes. Of course, you see it through here. There were no new all-time highs, not even one. So those are the years that are dangerous. And of course, 2022 for the NASDAQ and the Magnificent Seven, they were down about 50% during that time. But we've snapped back since. And then, of course, with the tariff tantrum, recovered since then. So the market hasn't seemed to been in a tantrum state for a while. And we can see that from the volatility. Of course, the tariffs were the last largest volatility that we had. And lately, our volatility is down around 17, which is pretty average, really. Where our normal average is about 18, and we're just a little bit below that, which is a little strange considering that we're at all-time highs. If we can look at the way value stocks and growth stocks have performed relative to each other, growth stocks are stocks that take their profits and then reinvest them in things like research and development and other market share. Whereas value stocks will pay their most of their profits are paid out in dividends, and they have a tendency to be a lot more stable, but they're not as the high flyers like the tech industry would be right now. So let's talk about that. The tech sector is a large part of the growth of the S&P this year. And in fact, it's very, very much like it was in the year 2000 with the dot-com bust. I'll talk a little bit more about that. But you can see the top two sectors really, especially this year, have been technology and communications. And a lot of that's been driven by AI. The parallel goes back to the dot-com, 2000, 2001 bust because of the ratio of the tech stocks that are in the S&P 500. So more than 40% of the S&P 500 is made up of tech stocks, and all of these are benefiting from the AI boom. If and when, and it's not a matter of if, it's just a matter of when that cycle, that sector rotates, then it's very likely that the whole stock market is going to rotate as well because it's so heavily invested in that particular sector now. Almost every investor who has been I guess these guys are Bank of America did a survey and said, asked almost 200 people with a $475 billion in assets, what they felt like about the market, and 70% are saying it's overvalued as well as expecting a stagflation. Just recently, Jamie Dimon, has come out and he says he's far more worried about a potential stock market fall than most of Wall Street. And you can tell that Wall Street is really not that concerned. He's saying in the next 6 months to 2 years, which of course is, I don't know, longer than I think a lot of people are thinking in terms of the time frame. But we've been expecting something for some time now. We've positioned ourselves well. Even Warren Buffett has come out and said, look, I mean, we're sitting on a pile of cash. And he's saying, look, the Buffett indicator, which is what he says is, mainly what he works with. And if the ratio is above 200%, that's essentially playing with fire. And well, what is that? Well, the Buffett indicator is where we take the total stock market value, the value of all the stocks, and we divide that by the gross domestic product. The gross domestic product used to be, only things that commercial companies produced and the market in general. But lately, they have been adding in government spending in the gross domestic product and government hiring into that, which is, I don't think, truly indicative of the economy itself. So we take the total value of the stock market and then we divide that by our GDP and we come up with a 217% ratio. And remember, he says anything over 200% is playing with fire. So I think we're well into the playing with fire range. And it doesn't really matter how you look at it, whether we look at price to earnings, whether we look at price to book, whether we look at price to sales, price to cash flow, or dividend yield, we're more than 2 deviations above the mean. And things always have a tendency to come back toward the mean. It's just a matter of time. But in every single case here, we can see that stocks are seriously overpriced. And every company like Jamie Dimon knows their book value. So Jamie Dimon knows the book value of JP Morgan, but he is saying, look, I mean, even knowing this, I'm telling you stocks are overvalued. And I think that's pretty transparent of him. I applaud that. The CAPE, which is the cyclically adjusted price earnings ratio, which we adjust for inflation, really has not been this high for the last 100 years. This is the third time it's hit this sort of peak, and the last time was the 2000 dot-com bust. And really the time before that was going all the way back to the Great Depression. I was just thinking this morning that the 1920s were the roaring 20s in that century, and the roaring 20s in our century too. So it's looking somewhat parallel. Although back in those days, I think it was more, I'm not sure, it was after World War I. So that was a lot of pent-up growth after World War I, kind of like we had after COVID, right? Corporate debt, pretty much across the board, large cap, mid cap, small cap, debt is pretty much at an all-time high. And of course, debt service cuts right into the bottom line. And the fact that interest rates are coming down is going to be a good thing for this debt, but it takes a while for that actually to work itself through. And in fact, the rate hikes haven't completely worked themselves through. So this is probably good news for the debt side of corporate world. Now, it definitely is. If we look at global equity valuations, how does the U.S. compare to the developed market, which is mostly Europe, and the emerging market, which is South America and the Pacific Rim? So obviously, emerging markets have not fared as well as the U.S. and nor has the developed world. The U.S. has just really been gangbusters, especially since 1995. So we've been leading the way. In fact, we've been leading the way so much so that the United States is producing almost 2/3 of the entire market global cap. So if we take an entire valuation of all the stocks in all the world, 2/3 of them are right here in the United States. That's just incredible. And that it really says a lot about American ingenuity and work ethic. But of course, we have our problems like everyone else. And so our big problem is debt. So let's look and see what economic developments have sort of occurred recently. Of course, the big one is the rate cut. The Fed lowered rates a couple of weeks ago down to 3.75. And there's been some differing views inside the committee there about, should we raise, should we lower, should we stay? And this is causing, a little bit unease, especially when they try to figure out what they're going to do next. And he's saying that, look, it's not necessary, absolutely true, that we're going to have another rate cut in December because we just really are playing this by ear. And of course, with the government shutdown for the last 40 days, getting information from the Bureau of Labor Statistics, when that information wasn't really that accurate to begin with. It's, I guess, a little bit better than no information at all, right? Which is kind of where we are now. So they lowered rates again down to 3.75, and the consensus is that that will continue on, and maybe we'll get down to 3% sometime 2027. We'll see how that goes. Depends on really how the stock market does. The other thing that they said was that they're going to cut back on what we call quantitative tightening. So quantitative tightening is the opposite of quantitative easing, and quantitative easing was an increase in the money supply to allow the stock market, basically more slush to fund itself. So quantitative tightening is the opposite, where we injected about $7 trillion right here during COVID, and then we peaked out, I don't know, another 7 trillion or so, and then we've been trying to reduce that down by about 6.6 trillion. So that's where we are right now, a 6.6 trillion on the Fed balance sheet, and this is where inflation resides. So this is money that was created completely out of nowhere and that went out into the economy and has made it into its way into the grocery stores and everywhere else. And that's why we see such high prices, because the value of our dollar has collapsed. And the other thing about that is gold and silver. We'll talk more about that in a second. But if we look at our debt, which is the thing that really concerns me, we're pushing basically 40 trillion. So we went from, 36 trillion to about 37 trillion in 180 days. We went from 38 trillion to 39 trillion in 71 days. So we added $1 trillion to our debt in the last 71 days. So now when we hit 40 trillion, will that take 60 days? Will probably take less than 71. And then after 60, 40 days and 30 days and then 20 days, and then we're adding another trillion every week. So I hope somebody gets this under control, because it's kind of in free fall right now in terms of the debt. We're almost to 40 trillion, and it won't take us long to get there. We may be there by the end of the year. And of course, with all that kind of debt has sent precious metals soaring. So gold this morning is about almost 4,200, and the silver is over $50 an ounce. And we saw this coming and loaded up on it. And so that's been one of the big benefits we've had this year. But generally, these precious metals will spike right at the same time the Fed creates stimulus. So if we were to have another market drop, and then the Fed drops interest rates down, and then we have stimulus, the precious metals usually will pop at that time. And that might be a good time for us to think about unloading some of it, because we have definitely seen 150, 200% increase there in our position. Leading economic indicators are still negative, and they've been negative for some time now. And these are the things that we have to happen first. So, for instance, a shopping center is going to go up. The first thing you see what you need is a building permit, and then you need surveyors out there. So those are the leading economic indicators that let us know that, hey, a shopping center is coming, and then soon there'll be new jobs, right? The jobs are kind of the last thing that happens. So these leading economic indicators are useful for us to kind of see what's coming down the pike. Now, the interesting thing here is that at least since 1970, in every single case where we've had these negative indicators, we've ended up with a recession. So every single time, 70s, 1980, 1990, 2000, 2010, with that 2008 crash, and 2020, of course, that was COVID. But here we are again, and we've been tracking negative here for quite some time. So that's obviously one of the things that we want to concern ourselves with. And I talk about how 2/3 or 70% really of our economy is driven by consumer spending. And we all kind of have an idea that consumers, when they feel good, they will spend more. And when they don't feel so good, they have a tendency to tighten up. And we can see here from our University of Michigan survey that consumer expectations, consumer sentiment is really very, very low. In fact, it hasn't been this low since the 1980s, almost 1980 exactly. So that's a concern, because that could be a self-realization in terms of not spending, and that curbs earnings, and earnings curbs share prices. So that's obviously something that we want to watch. Inflation probably plays a big part of that, because it's a little depressing when you go into the grocery store and you come out with 4 bags in your hand and you just spent $100. I just did it yesterday. The commercial real estate performance, obviously, that's still a concern. A lot of these leases have not come to fruition yet, in which case somebody's still paying the lease, but that office space may still be empty. And our office building is probably 60 to 70% vacant. And that's not uncommon around the perimeter area. And from what I read, it's not uncommon from around the country, especially in cities like San Francisco. So, just to take a step back here, I want to talk about some new things. These are essentially lessons that are new, because if you go to a dinner party or a wine luncheon or something, you're talking with your friends, and the economy comes up, and you say something like, "Oh, have you seen those junk bond spreads?" Everybody's going to sort of stop and look at you and say, "Wow, you have really educated yourself." So let's talk about these three things. The first is junk bond spreads. And the other name for junk bonds is high yield. So high yield junk bonds. And the reason they call them junk is mainly because of the credit worthiness of the companies that are loaning this money, or borrowing this money, I should say. So a AAA rated company, say like Apple or Microsoft, their corporate bonds are going to pay in the range of, say, 4.5%, something like that. But because they've got cash, they got plenty of cash. Even if they default, they're not going to default because they got cash. But there are other companies out there that don't have a lot of cash and are leveraging, and they're borrowing money to move their operations. And because of that, they're having to pay a higher interest rate. Well, that's normal. If you look what's happening right now, the difference between what we call the spread, which is the difference between those AAA companies and those junk companies, is only about 2.8% right now. And historically, it's closer to 5%. That means there's a 5% difference between the junk companies and the AAA companies. So what this is telling us is that investors, especially investors in bonds and in high yield bonds, especially these junk bonds, are not thinking about risk. Okay, so it's risk off in terms of that, which is a dangerous sign, because if they were thinking about risk, then the AAA bonds would be paying a lot more, and the yield of the high yield bonds would be paying a lot more too. So the next thing we want to look at is margin debt. Now, margin is the ability to borrow against positions in your account, a brokerage account, and essentially borrow money and use that money to buy new stocks. So what's happened here is we have margin balance of $1.126 trillion in the United States. That's money that has been borrowed, that has been used for the most part, at least $1 trillion has, to buy stocks. Now, the last time we've seen something like this, was 1929. People have always been using margin, but this percentage of the overall market hasn't been seen since 1929. So that's another thing that we really need to watch, because this means that people have borrowed money to buy stocks, and if those stocks were to turn around, then they may have a margin call. Okay, I just had a question. I'll come back to that in 1 second. So we do have a Q&A. If you look below your screen there, you should have a question mark, and you can just ask me a question. I'll get to it as soon as I can. All right, so the next thing we want to talk about, remember we talked about the spread between junk bonds and quality bonds. We're talking now about margin debt, the amount of money that investors have borrowed to buy stock. A lot of that's probably AI stuff. And then the derivatives market. So the derivatives market is things like options, futures, forwards, and the easiest way to think of that is a call option. So if I have a company, ABC, and it's currently trading at $50 a share, I can buy a call option to buy that stock away, or buy that stock at $55 a share if it hits that. And I only have to pay $2 for that. So if I were to buy that stock, okay, one option contract covers 100 shares. So I could buy one option contract for $2 per share and control $5,000 of stock. So $200 allows me to control $5,000. And that's what we call leverage, major leverage. And so if that $5,000 goes up, a few cents, then my option goes up several cents, maybe a few dollars. And that's leverage. But the opposite is also true. If that were to drop by a few dollars, mine will drop by many dollars, okay? Because it's magnified, and it can be magnified 10 to 1, or it could be magnified 100 to 1. You just don't know. So that's why derivatives are really sort of an unknown in a sense, because we don't know exactly how much money is controlled by derivatives, and we don't know exactly how much money all those derivatives are worth. But in the United States, I can tell you that we're talking in the hundreds of trillions of dollars. So the notional amount for U.S. commercial banks and savings was a couple of $100 trillion. Okay. I've heard the word quadrillion thrown around when we're talking about international valuations of these derivative markets. Okay. And these are hanging off of something. They're hanging off of gold or silver or Coke or Pepsi or Apple or any particular stock or any particular commodity, pork bellies, frozen concentrated orange juice, uranium, plutonium, steel, lithium. It does not matter what it is. There is a derivative markets on it, and it is huge. So when first people we hear, like, we're talking about hundreds and hundreds of trillions of dollars out there in derivatives. What are you talking about? This is almost a scary thing, right? This is amazing. So, when we look at all the different things that are happening, the margin debt, the spread between the bonds and the high yield bonds and the corporate bonds, and then also all of the derivatives that are attached to the stock market, it sets ourselves up for the perfect storm, really. I mean, I'm really calling that the perfect storm, because if we have a pullback in that one sector, the technology sector, it's going to send all this stuff in the free fall. I really do believe it. But there will be an opportunity to pick up some good quality stuff, especially in the values side of things. So we could also, if things drop like they did in 2008 or in 2000 with the dot-com bust, the tech sector will probably be down about 50%. That would be a good time maybe to look at picking some of that up. And then the value stocks, the ones that keep producing the dividends, the utilities, energy stocks, and then consumer staples and cereals and shampoo and toothpaste and things like that continue to pay dividends. That may be another place to look, and we certainly will be looking at that. So what we're going to do is we're going to drop it off from here, and this is really going to be our last communication for the year. And the thing that you need to do is to stay healthy and to have fun and to not stress and to see your family and to not argue with your family. I know that's a challenge for all of us, but we need to see it through. We have Thanksgiving and Hanukkah coming up, and also obviously Christmas, and I don't know about Ramadan. I don't know if that's coming up or not. I think something is coming up. But anyway, we want to spend time with friends and family and stay happy and healthy. And I really appreciate you guys tuning in, and I appreciate our relationship. And please contact me if there's anything I can do to help you or anyone here. Have a great day.